Welcome to this edition of Fuel for Thought, the podcast where we explore the forces transforming the global automotive industry. I'm your host, Guido Vildoso, and today we're diving into the dynamic landscape of Chinese vehicle manufacturing and exports. Chinese automakers are not only reshaping their domestic market, but are also becoming formidable players on the international stage. Their aggressive expansion into overseas markets, driven by a combination of competitive pricing, innovative technology, and strategic partnerships, poses both challenges and opportunities for established automakers. Moreover, as trade barriers and regulatory changes emerge in various regions, understanding how Chinese manufacturers adapt can provide valuable insights to the future of global automotive supply chains. Joining me today is Abby Tu, Principal Research Analyst at S&P Global Mobility. We'll discuss how Chinese automakers are navigating global markets, the impact of tariffs and trade barriers, and the strategies these automakers are employing to expand their footprint. Abby, welcome.
Thank you, Guido.
Let's begin, Abby. Let me ask you, can you provide an overview of the current projections for mainland China's vehicle exports in 2025, and what are the key drivers behind this growth?
Sure. Let me first share with you some recent data on exports. We're now in the fourth quarter of 2025. In the first 10 months of this year, China has exported over 5.5 million vehicles to global markets. Between August and October, average monthly export volumes of China stayed well above 500,000 units. So with this momentum carried into the remainder of this year, China's vehicle exports will reach over 6.5 million units in 2025. To put this into perspective, last year the number was around 5.9 million units, so already a high base. And in terms of exports share in overall sales, they make up over 20% of China's total vehicle sales. So really make a big component of Chinese auto sales. And you mentioned key drivers behind this global push of Chinese car makers. One major driver, I think, is the search for bigger markets overseas to divert from the intense competition in the Chinese market. Our forecasts show a competition in the Chinese market will remain intense in 2026. This is because China apparently has a large number of car makers and new car brands, resulting in the issue of oversupplying of new cars. This in the context of slowing economic growth and weak consumer sentiment means automakers are constantly faced with the pressure of having to either cut prices of their cars or launch new models to attract car buyers. Another important driver behind this is company's long-term strategic aim to develop a global sales network to compete with global car makers. Chery Auto, for instance, already sells half of its vehicles overseas. That means Chery has already been competing with Western car brands and their major Asian rivals in many markets, for instance, Southeast Asia and South America for many years. So looking ahead, Chery's strategy is really to develop this edge over other Chinese counterparts and enter into new markets, especially developed auto markets in Europe, to support its global expansion.
Thank you, Abby. And funny that you mentioned Cherry. I was just riding on one of them yesterday. But let's talk about the other brands. How are domestic manufacturers shaping this export landscape?
China's domestic car makers are really the driving force behind the surge in vehicle exports over the past 3 years. Chery, I mentioned earlier, is the top passenger vehicle exporter by shipment volumes, and Chery has been leading the export sector for over a decade. BYD and SAIC both have significant export volumes. BYD in particularly has experienced rapid export volume growth in the past year. BYD's push into global markets is driven by slowing sales in China but it's also driven by its efforts to be able to gain influence in international markets to compete with well-known established car makers like Volkswagen and Toyota. Having said that, I think it's also worth mentioning that global car makers, including Nissan, Mazda, and Hyundai, they are also working with their Chinese JV partners to develop their exports business using manufacturing plants in China. This helps them to really make use of the production capacities they have in the country, and it is also a wise move for smaller automakers like Mazda to use their Chinese partners platform and China's EV supply chains to develop electric cars for global markets.
Great insights. With increasing trade barriers in various countries, how are Chinese car manufacturers adapting their strategies to maintain competitiveness in international markets?
Because of changing trade policies, in the past 2 years, Chinese automakers' investments in manufacturing plants overseas have increased significantly. Tariff, of course, adds costs to consumers, and it also increases operation costs for manufacturers. Companies cannot simply shift their additional costs to buyers, so they are seeking to absorb the tariffs through a combination of measures, for instance, reviewing their own cost structure or go back to suppliers to try to negotiate a better price on components and parts. And they also would increase offerings of plug-in hybrids and full hybrids models in other markets. Another measure is to really look at the plans to localize production of some models to circumvent vehicle tariffs.
Let's focus on that last point. Would you please elaborate on the trend of Chinese automakers investing in overseas vehicle manufacturing? Are there any particular regions they're focusing on and why?
Well, I think there are a few basic factors that would affect automakers' investment decisions regarding new manufacturing plants or even manufacturing partnerships. The top one of those would be geopolitical situation that to a great extent would affect the trade environment in a region. And the second factor is the economy of that specific region, which determines the purchase power of consumers. The third one, and also is an important one, is the region's automotive manufacturing foundation. So take these factors into consideration. Southeast Asia, South America, and Europe emerge as hotspots on many Chinese automakers' investment maps. In Southeast Asia, take Malaysia for example. Malaysia is the largest auto market in the region, and it also has a well-developed auto manufacturing industry that supports automakers to launch production in the form of CKD manufacturing. CKD referring to the process of assembling vehicles from completely knocked down kits. Because of that, Malaysia has been the region's automotive production hub for a long time. But in recent years, investment in local assembly through CKD is really driven by Chinese companies such as Chery and Geely Auto. Outside Asia, Europe makes another important region for Chinese car makers because Europe has considerable demand for EVs and PHEVs. These green vehicles are key products in many Chinese car makers' product offerings. Also, to promote adoption of EVs and plug-in hybrids, countries need to have a stable and expanding charging infrastructure that is more developed in Europe compared to many developing markets. And another element of Europe's appeal to Chinese car maker is the region has high standards regarding to many aspects of auto manufacturing. For instance, vehicle safety, vehicle emissions, and also data privacy. So being able to really meet these requirements help Chinese automakers to up their levels and compete in the international stage.
Let's expand a little bit on Southeast Asia. We've spoken about Malaysia, but there has been significant Chinese investment in the region. What are the implications of changing import incentives in Indonesia, for example, for Chinese car brands?
Well, in the near term, because lower tariffs secretly keys compared to tariffs imposed on whole car imports entering the region, Chinese automakers will increase local production by investing in either their own manufacturing plants or setting up production lines with local auto assemblers. Gradually, countries like Indonesia will tie their incentives, for instance, preferential um, tax rates to local sourcing. So these policies will require automakers to source certain percentage of components in the countries they are operating in to help develop local supply chain. In this process, there's an opportunity for Chinese suppliers as well for them to expand their business in production hubs in Southeast Asia, especially suppliers specialized in key EV components manufacturing, for instance, power batteries and electric motors. For Chinese automakers, being able to promote the development of such an ecosystem helps the key for them to really deeply integrate in the auto manufacturing sector of an investment destination. And that is also the kind of high quality global initiative China wants to cultivate for its auto sector.
Let's shift towards Europe. Despite stringent tariffs, how are Chinese OEMs responding? What strategies are they employing to expand their manufacturing presence in the region?
The EU's EV tariffs on Chinese vehicle imports currently are primarily targeting battery electric vehicles. So, since the implementation of the new tariffs in late 2024, Chinese automakers, including SAIC, BYD, and Chery, have increased their offerings of hybrids, including plug-in hybrids, vehicles in Europe. The surge in Chinese PHEV exports over the past 12 months really reflects these efforts of Chinese car makers to bring more hybrid models to European markets to cope with EV tariffs. In terms of their approach to start local production in Europe, it really depends on automakers' own business strategy. BYD, for instance, has committed significant investments in the region to constructing its own passenger vehicle plants. These factories are not designed just to make pure electric vehicles, but will also make BYD's plug-in hybrid models. BYD started in the region at a relatively low sales base, but for the longer term, BYD has ambitious targets for Europe. That is why the Chinese automaker really pushes hard in the region. For smaller OEMs, they prefer to adapt a relatively safer strategy to begin to launch production in the region. For instance, entering into contract manufacturing deals with companies like Magna to assemble vehicles in Europe. China's GAC and Xpeng are both pursuing such a strategy. And there are also joint venture partnerships between Chinese car makers and global companies to share platforms, share sales network, and also important parties' manufacturing capacities. Leap Motors' partnership with Stellantis, for instance, has really quickened Leap Motors' pace of expanding sales in Europe. Such a deal also enables Leap Motors to use existing plants operated by Stellantis to produce its vehicles in Europe.
It seems like partnerships with global automakers are becoming increasingly important. For example, Leapmotor and Stellantis. Can you discuss some notable collaborations and their impact on Chinese exports?
As to partnerships, in addition to Leap Motors' partnership with Stellantis, I will share one recent example, which is Geely's partnership with Renault in Brazil. Geely acquired a stake of 26% in Renault's Brazilian unit. And following these investments, the two companies are really working together to develop new Renault models based on Geely's new energy vehicle platform. This is also an important deal for Geely because it will help the Geely brand launch new models in Brazil. Brazil is the largest auto market in South America, but Geely only started to sell cars under Geely brand in the country recently. Through its partnership with Renault, it is also likely that Geely will start production of models under its own brand at Renault's plant in Brazil, therefore reducing its reliance on vehicle imports from China. This approach is also in line with Geely's business strategy, which is centered on achieving cost efficiency and driving business synergies. We have already seen Geely consolidate its business in China to achieve great synergy among brands. So its deal with Renault in Brazil is the continuation of such a strategy to cope with intense competition.
Thank you, Abby. And those are some great points. I can't help but think about the fact today, as this recording is taking place, I'm in Mexico City, and there's a lot of attention to how quickly Chinese manufacturers are going to set up a plant down here. But let's talk about how should established automakers respond to this increasing presence of Chinese manufacturers in global markets? What key areas should they pay attention to in order to remain competitive?
I think for sure we will see increasing competition in many international markets in the next few years. Many global automakers have already begun to address this challenge from the rise of Chinese car makers by incorporating new technologies in their next generation models. For instance, new automated driving technologies, new ADAS systems, and new smart cabin systems to really increase the competitiveness of their new models. And also with regards to powertrain strategies, collectively, I do think Chinese car makers, they offer a really diverse range and also a very comprehensive range of electrified powertrain options, including BEVs, PHEVs, full hybrids, and even vehicles with range extending systems. These powertrain technologies have already been deployed at high volumes in China. Therefore, these technologies have gone through several rounds of technology upgrades to better address consumers' demands regarding energy efficiency, power performance, and charging speed. So, with vehicles featuring these new technologies reaching international markets, it could have appeal um, to a buyer in global markets if offered with competitive price. That is one of the key reasons that many global car makers are now working with Chinese tech companies and Chinese automakers to incorporate these new tech solutions in their global market models. I think that would really help them cope with the competition from Chinese brands.
Abby, thank you so much for sharing these great insights on the evolving landscape of Chinese vehicle manufacturing and exports. Today, we've explored how trade dynamics, investment strategies, and regional market conditions are shaping the future of Chinese automakers on the global stage. As the industry continues to evolve, the key question remains: how will Chinese manufacturers balance growth with challenges of global competition? Thank you to our listeners for tuning in. Don't forget to follow us on LinkedIn at S&P Global Mobility and explore our latest insights at spglobal.com/automotive-insights. We'll be back next month with another episode. Have a great day.